Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'll be your host today. And really excited to have Aleksey with us today. I'll let Aleksey actually pronounce his last name because I totally butchered it as we were preparing it. But Aleksey is the founder of Centrio Capital Partners. He helps LPs on existing and future investments. And prior to doing this, he ran Store Capital's $10 billion commercial real estate portfolio and oversaw their firm's underwriting team. So Aleksey is really the perfect guest for this audience to help us dig in and learn more about passive investing. So Aleksey, welcome to the show.
Thank you so much for having me, Randy.
Awesome.
I heard you live very far away.
Yes. Actually, we're probably 20 miles apart, so it's not too common. We could have actually done this in person, which is not always the case for sure. So, well, let's dive in. We'll kick it off how I always do. Can you give us your current assessment of how you think the market is and how that might be impacting passive investors?
Yeah, I think the biggest change over the past 2 years, I guess probably twofold. Number one, I think that economics are getting more LP favorable relative to 2 years ago. So I think it was fairly normal to have like 60-40 splits with maybe like a 6% pref circa 2021. I think right now we're back to like sort of an 80-20 above an 8 on average. So I guess if you're an LP and you're listening to this, I would definitely encourage you to get out there and see what type of economics exist. Deal flow rules the world, as I say sometimes. So that's number one. I think the second biggest thing, Randy, is just the lessons that are coming in have pretty big implications as to what LPs do next. And I think it's pretty binary. I'm hearing from a lot of LPs that have investments not go as planned. And the response is, wow, I really had no idea what I was doing. Like, maybe I should get educated. Very valid idea. Or the opposite, which is, hey, I didn't know what I was doing. Not really sure I have time to get educated, but now I know that I should just stick to index funds or whatever. And I think people are generally taking a pretty binary path.
Yeah, I think those are both very relevant topics for today, and for the listener, I think it'll be interesting to kind of dig in and hear your thoughts on those in a little bit more detail. So, before we kind of dive into that in a little more detail and what else we're seeing in the marketplace, can you give us a little bit more about your background? Clearly, you were in charge of managing a very large amount of capital. But tell us a little bit more about that, how you landed in that role, and what kind of caused the transition out of that, I guess, as well.
Yeah, landed there through a referral from a friend when I moved to Arizona. Very, very thankful for that referral. And as you said, eventually I was an SVP overseeing close to $11 billion. I think it was 2,900 properties, give or take, in the U.S. And I basically ran two functions: the underwriting function, which essentially looked at anything that we were going to buy, and then assuming we bought it, so I sat in an investment committee, which is sort of like the decision panel, so to speak, on whether we should buy something or not. And assuming we bought it, it would fall back into my portfolio that I managed with the help of 20 amazing people. So that's sort of my corporate background, if you will. At some point, I decided to go out on my own. Stumbled upon, to be honest, like this GPLP universe.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
All right. So yeah, let's go ahead and jump back in if we can. Can you tell the audience a little bit more about yourself and how you found yourself in the position to manage $11 billion in assets? And then what kind of drove you into this new role that you're doing today, educating LPs?
Yep. So the short story is I got referred into the role. As you said, ultimately managed close to $11 billion, 2,900 properties in the US, give or take, with a 20-person team. And yeah, it was a wonderful experience. I was like very thankful for it and saw a lot. We bought typically $1 to $2 billion a year, saw a lot of deals. And so, that gave me like a very unique experience. When I left, I was searching for what to do, and I kind of stumbled upon the GPLP marketplace. It wasn't something I was so familiar with at the time. And a few things occurred to me immediately. Number one was that it's a pretty big universe. There's a lot of money that gets deployed into it. I also realized that many times the LPs aren't coming from an investing background. And on the flip side, I also realized that all GPs are not equal. And, some are very good and some are slightly sketchy. So I essentially decided I guess the overarching goal was maybe I can make things a little bit more transparent in the marketplace. And I have like many goals for that. But step one was give LPs advice. Step two is, hey, can I show LPs more deals so that they can sort of accustom themselves to what's out there. And hopefully we'll get to step three and others one day.
Okay. Yeah, no, it's been interesting to watch your process. You really just kind of came into the space, I don't know, 6, 9, 12 months ago, like a relatively short amount of time in LinkedIn world anyways, where I've had the most exposure to you. But it sounds like you've had amazing growth in this little amount of time, and you're having a really big impact connecting LPs and GPs. So I'd love to kind of dig in, if we can, about the advising piece to LPs, both on existing and current opportunities. And I'm curious, what does that process look like? Is that a one-on-one engagement that you do with investors, or are you just simply reviewing their current portfolios, or what does that whole process look like? I'm curious.
Yeah, you guessed right. It's typically one-on-one. On a future deal, it's typically they send me the deck, sometimes the PPM if I have questions on the legal side. And then on the existing LP stuff, it's just a little bit more complicated. Like, it depends what they need. Like, if many times, as you can imagine, people are reaching out to me due to the stress or capital calls. Sometimes people just want valuations and thoughts on like, hey, how is this going? What should I do? Maybe there's some sort of decision to be made. So it's very one-off, but I would say all of my engagement today actually have been one-on-one.
Okay. Interesting. Yeah, and there's been a lot of kind of turmoil in the space over the last probably year and a half, 2 years, with those less sophisticated GPs getting paired up with less sophisticated LPs. And now some of those deals are going south because of all of the challenges people are seeing with, just the economic trends. And then the biggest one, the debt challenges that people are running into. Do you have any kind of general comments you can make about what you're seeing and where you see the direction of this going? I know you mentioned in the intro that you think it's much more favorable today, but a lot of LPs have a lot of dollars tied up in deals that are less than great, I would say. So curious your thoughts there.
Yeah, I mean, first I would just say it's not just the not so sophisticated GPs getting in trouble. There's plenty of very large sponsors that also got caught. not everyone is immune. Really, no one is immune in a sense unless you just basically set out and bought very carefully. Um, in terms of what I expect to happen, I think you're spot on. Like, a lot of people are pretty unhappy. Some didn't even realize that losing money was a possibility. They're realizing that's the case. They might be sitting on liquidity, but they're not really thinking about deploying it back into syndications now, because they realize that. I mean, to be honest, Randy, they realize things that they should have realized before investing, which is this investment is illiquid. There's a chance of losing money. I need to understand the upside, but not forget about the downside, right? But some of the investors are learning this the hard way, so I think many of them will sit the next 5 years out. Generally speaking, it's a pretty hard fundraising environment right now. Um, on the one hand, less deals are getting done. There's just not that much trading hands in terms of deal volume. But there's also, I think, less LPs investing. So the pool of capital has shrunk a bit. And it's an interesting place to be.
It really is, yeah, because when you look at the deals today compared to the deals that we were seeing 2 or 3 years ago, the deals are much better today. We're seeing a lot more fixed rate debt. And just because interest rates are higher doesn't mean that they're not as good of deals. In fact, they're quite often much better deals today. So yeah, I think it's interesting. And it's too bad that the past investors got stung, and that'll keep them from playing in the arena today, which is arguably a better time to be deploying capital in the space. So, well, with that, I'm curious. I'd love to kind of dig in as you're looking at deals. Obviously, if when you were placing $1 billion to $2 billion a year, that underwriting process must have been rather extensive. You were actually deploying a significant amount of capital, and you had a big team doing that. But what did that structure look like, and how can passive investors try to mirror or replicate or learn some lessons from that proper process to bring into their own passive investing?
Yeah, sure. Honestly, the biggest lesson by far is volume. Like, the best thing that LPs can do for themselves is see more deals. The reason why I say that is, well, there's basically two types of LPs. Ones that invest blindly, and in my opinion, that's basically gambling. And I don't know. I guess it's up to you if you want to do that or not, but I don't recommend it. Or you're taking this seriously, and it's like a real investment, and all investments carry risk, and you need to understand those risks, and you need to understand the upside. So if you fall in the second category, which I think where most LPs think they are, but I don't think they actually are there, then the next step is, well, okay, if I only have 2 deals in my inbox and I have $1 million to invest, like, I'll probably choose one of those.
Sure.
But
Sure.
so, or 2, whatever, I don't know. But my point is, you need to increase your sample size to make sure that the sample size is representative of the population, right? And I find that this is probably the biggest problem with LPs today is they assume that a random deal that landed to them through their cousin or uncle or whoever is sort of normal and it's good. And that really, I think there's sort of like courses, this, that, personally, I've told people, like, this is market terms and this is what you should look for. But I personally, and I think many people, learn best when they just see something many times. And then when they're able to compare across deals, you just develop sort of like a muscle, Randy. You develop a muscle for, like, oh, that seems strange. This feels weird. Pass. But the only way to develop that is time and seeing a lot of opportunities.
Well, it seems to me, and I share this almost as a joke, but it seems like somebody sold an investor deck, a generic investor deck that said, we're going to give you 14 to 16% IRR. We're going to double your capital in 4 to 6 years, and we're going to give you 3 to 5% cash on cash. And 90% of the operators, their deck is going to look very, very similar to that. We're doing a 7 pref with a 70/30, and that probably encompasses 80% of what you see. So when you see all of these deals that look essentially the same from an OM standpoint, what's a passive investor to do to dig in to truly understand the difference between those? Are they digging into underwriting models? Are they meeting in person with these groups? Like, what should that due diligence process look like, do you think, so you truly show up as a sophisticated LP investor?
Yeah, so the last thing I personally look at in any LP investment is the property itself. The first two things I look at are the sponsor, i.e., what does their background look like? Any background is fine, but you need to understand what it is and make sure that they're being transparent about what it is. There are many cases, Randy, of let's call them inflated backgrounds, or dishonest, perhaps.
That's
another way of saying it.
Yes.
And the second thing I look at is alignment of interests. In other words, how am I, the LP, aligned with the GP? And you have enough work cut out there between those two that sometimes you don't even get to number 3, which is the property. But when you do, then you compare all those 3 and you say, well, maybe this property is so interesting and it's so well underwritten, it's conservative, and I might forego, I might be fine with the fact that this might be the first property that they're buying and they're early in their journey because the alignment of interest is so good.
Sure.
Right? And you can see how each factor could offset each other over time, but it really just starts with the sponsor and the alignment, in my opinion.
Okay. No, I like that. I agree with you 100%. I'm curious your thoughts from an alignment standpoint. I've seen a handful of operators that are starting to do away with the preferred return, which I personally like. The fact that we're seeing less of preferred returns, I think preferred returns can cause operators to make decisions with these assets that are not in alignment with the investors, because it causes them to potentially sell or refinance so they can make money on the deal and get their catch-ups and those types of things. Whereas removing a pref, hopefully if this asset is cash flowing from day one, there's some potential income for the GPs as they continue to improve operations. So curious what your thoughts are on preferred returns and whether you like them or not, or have a preference between the two.
I think it depends what the goal of the LP is, right? Like if you're investing in an evergreen vehicle and you sort of have a very long-term mindset, then perhaps a pref makes a little bit less sense. If it's a shorter-term hold, all else equal, I think it's extremely important to have a pref, because the entire point is the LP, am investing most of the money of the deal. And in other words, I'm taking most of the capital risk, right? Typically, I don't know, let's say 10% is a co-invest from the GP, and 90% comes from the LP. So I think it's obvious that the return of capital needs to come first. And the idea is that I also want to make some sort of return before the split occurs. Now, this is where, basic logic comes in, Randy. If you tell me, hey, which one do you prefer? 80-20 split with an 8% pref, or no pref but 90-10 split, right? So that's a conversation. You might have LPs that prefer 90-10 split, above a 0, so to speak, right? And you might have LPs that prefer the other one. But I think where people get caught up is somehow it doesn't go from 80-20 split above an 8 to 90-10. It goes to like 60-40, with no
Right.
pref.
Right.
And you're just like, wait, that's the wrong direction.
Right.
you know
Right.
so the pref is there for a reason. I mean, this is more like a marketing question for GPs. I think not having a pref is just so market that I think LPs are not used to it, you know. But more sophisticated LPs can, crunch numbers all day and tell you which one they prefer.
Yeah. Yep. Yeah, no, it's interesting, and obviously most people like the pref, and I started seeing some operators where they weren't doing it. I really got my head around it because, if we are, to your point, if we're holding this asset for 7 to 10 years, I want these operators actually making some money, because ultimately, if they don't feed their business, the business won't be in place to take care of the assets in the long run. So when you see operators that are potentially selling too soon just so they can get paid, I think that hurts the LP in the long run. So
Maybe don't forget about fees too. You know what I mean? Obviously, I'm not saying you are, but like it depends what happens with fees. So if you're on a long term hold and there's much less fees, but you're participating in the cash flow, maybe that makes sense. If you're double dipping and you're just saying, hey, I want no pref and I'm going to get my asset management fee, but like, then it's like, I don't know. Are they selling early to get their promote, or they're just keeping it in order to keep the management fees, right? Like it's tough.
I mean, so you mentioned fees as well. I'm curious. We're seeing where some of the bigger shops are starting. We're seeing acquisition fees starting to tier up. So I'm wondering, do you have a line in the sand where you just say, I won't do a deal if they're charging X percent acquisition fee or X percent AUM or property management or any of those fees? Are there line in the sand fees that you have?
Um, it's not really a line in the sand, but for sub like $50 million deals, I would say it should be pretty important for a co-invest to be more than the acquisition fee in dollars. Many times they're not. Obviously, as deals get bigger, it becomes more and more difficult for a GP to reasonably do that. Um, that's one thing I would say. In terms of like percents for acquisition fees, I guide to lower than 3. Um, and obviously, the bigger the deal, the lower it should be, right? But again, I think GPs are this is the tough part about this marketplace is you don't really get feedback from LPs on why they passed. They just pass and they make some excuse. But many times it's because something is fee heavy, upside isn't there, right? They might like the deal, but they just think your structure is outrageous. And at that point, the GP needs to make the decision of like, well, should I keep a simpler structure but make it easier for myself to raise money? Or do I want to capture more of the upside myself? Because I have enough investors, even at this more, I guess, let's call it aggressive structure.
Sure. Okay. No, that makes sense. Definitely. It's certainly a balancing act, and understanding LP feedback, I think, would be a critical piece to adjusting those. But yeah, to your point, that's not always there. So, well, let's if we can transition a little bit. I'd love for you to talk about the service that has evolved from you and from your team now. We've seen this grow significantly, and you've had some pretty neat milestones, I think, in the recent months. Can you tell the audience what it is that you provide, actually free of charge at this point, is my understanding, correct?
Yeah, it is. And to be clear, the team is me, myself, and I.
All three of you, yes.
Yeah, the team is a team of 3. No, just kidding. So the
Alter
service you're
egos
referring
there
to,
as well, right? Yeah.
yes, exactly. So the service is GPLPmatch.com. As an LP, you can sign up and put in any sort of filter you want that helps you get deal flow that matches what you want. So you can say, I want to get, I don't know, RV park deals only in Arizona, and they must have an 80% split and a 10% co-invest, right? Or you might want to say, well, I only want retail deals, but they have to be in Texas. with X, Y, and Z parameters, right? So you can put as many parameters as you want. And on the GP side, GPs are submitting deals. The deals must be 506C. And to the extent that that deal matches a given person's criteria, that person will get an email, and they can reach out directly to the GP. Well, I'm like totally sort of removed from the whole process. I'm just the email guy.
Sure. No, it's amazing. Yeah, I signed up, I don't know, 3 or 4 months ago, and I have a steady stream of the specific type of deals that I am interested in. And what's been really eye-opening to me is the amount of volume and the amount of operators that I just was not aware of. I've been operating the space for 5+ years, and they're like almost every single deal that's come from my inbox or come in my inbox from your offering is an operator that I had never even heard of before. So
it's a really big universe.
It is. Yeah. And these are just 506Cs, which really make up a very small portion of the alternative investments that are out there, according to some SEC attorneys that we've had on the show recently. So do you have a sense on where this is going, how it's evolving? I get the sense that you had no idea how popular this would be just based on some of the feedback I see on social media. But do you have an idea or a vision for where this might be, 6 months, 12 months, or a couple of years from now?
Honestly, not really. Like, a part of me just says, let's keep it simple, keep it a team of 3, as you said, i.e. myself, and just slow and steady wins the race. A part of me says, like, maybe this is something pretty special and I should scale and get investors and all that stuff. But I really haven't made up my mind, to be honest.
Yeah, I think there's a lot of opportunity here. Clearly, there's an appetite from the LP standpoint to get access to these type of deals. And a marketplace, I think, could be really valuable. I think there could be potential for a community around this. I think there's plenty of opportunities for monetization on your part as well. Could be interesting to see. I know there's a group, gentleman that I know that runs a company called Visor, which is like an LP tracking tool that he's now compiling data about returns at the GP level, which you start thinking like, that's some really valuable data that he has access to that he could potentially share with LPs down the road, as well as kind of a third-party verification of, yes, they pay distributions, or yes, they do updates, or whatever that may be. So it could be interesting. There might be some synergies between your company and theirs as well in the long run. So very interesting.
Yeah, he's a great guy. I know him well.
Oh, you do? You're good. He and I were talking this morning, as a matter of fact. So
nice.
Well, very cool. Well, what do you, we got just a few minutes left here before I got to jump into my final 5, but what do you see in the coming years in this space? Who knows what the GPLP match will be in that space, but what do you see for passive investors? Are we going to continue to see this trend towards capital being very difficult to get, so we'll see economics continue to improve for LPs, or is it that great unknown with everything that's going on in the marketplace?
I don't know. I have a hard time imagining that like LP capital will become as easily available as it was in like 2021. It's hard for me to predict out more than a year, but within this year, it's hard to imagine that. I think the problem is these things are liquid. Most LPs have already made an LP investment. I'm just, I guess, generalizing, but I think that's true. And many of those have an investment that might not be going according to plan, right? And so they might be waiting, like, let's see what happens with this one. The chances of that investment, like, all of a sudden, doing well, I think is relatively low, right? So, I think a lot of people are like sort of on the sidelines for some time. They might be watching, learning, but I just don't see it becoming like a much easier marketplace anytime soon.
Yeah, no, I would agree. I would agree. I'm, to a certain extent, I'm somewhat in a holding pattern as well. My own, I'm an LP in 25 positions, and I have some concerns about some of those, obviously.
Yep.
The deals that I am vetting for our investors, it's getting harder and harder for me to find deals that fit my criteria and make it through my due diligence process. So they're very few and far between. When they do come up, they're great deals, but it's really difficult to find to find deals
Hard to
that
find.
make it through. So it's an
Yep.
interesting time. I think the next year will be critical to kind of the foundation and what we'll see in the future years. But who knows? Who knows is
Who knows?
my
Yeah,
advice to
yeah.
bikes. Yeah. So
I agree.
well, very good. Well, let's if we can, if you have a couple of minutes here still, I do have a handful of questions I'd like to ask
Yeah.
everybody. So, as a show that gears towards the newer passive investor, is there an educational resource that you would refer newer investors to either start or continue their education journey in this space?
I mean, I guess shameless promotion, but I run a blog that I hope is pretty helpful, which is lplessons.co. Um, Randy, to be honest, like one of the biggest reasons why I started writing was because someone recommended a book, and I'm not gonna name that book for a reason. Um, and I bought it. I opened it, and on the first page that I opened it, I found a mistake. I emailed the author, and the author didn't respond. And this is like, let's call it top three most known books in the space that many LPs
Sure.
are like obsessed with. And I was
Yep.
like, okay, look, people make mistakes. I'm not saying you need to make a new edition because of it, right? But but clearly, maybe education is missing in the space, especially for how much money is being deployed. And that's what got me into the space.
I love it. Yeah. So you, not only your LPGP service that you offer, the blogs that you're writing, the content that I see you put on LinkedIn is absolutely amazing. So for the listeners that are out there, sign up, get your deal flow coming through, and then spend some time with his content because it is hands down some of the best content out there about this space. Do you have? I'll kind of tailor this question a little bit different. So, are there favorite books of yours or educational resources that you've personally used to continue to refine your due diligence process and your ability to continue to vet deals better and better in recent years?
Um, I don't listen to like podcasts so much, and I probably should read more than I do. But the one thing that stands out is like more entrepreneurial, I would say. Like I've had a lot of like entrepreneurial struggles. And I think the most helpful thing has been a podcast called Founders by David Senra. It's just been very cool to listen to. I find it to be pretty like well thought out and many times pretty inspiring during the ups and downs, which sometimes are 1 hour apart.
Yeah, no, tell me about it. Trust me, I can relate to that, Aleksey, definitely. Yeah, no, I love that podcast. I am at the point now where I've listened to the last year and I'm going further and further back because I've got this desire to hear more and more from them. So there's another great
That's
one
awesome.
called Acquired, which is another
Oh
great
yeah, yeah,
podcast,
I've
kind
listened
of
to that
in
too.
line with that as
Yeah.
well. Two great ones. So yeah, certainly to the audience, if you're not listening to those, listen to those. Um, well, let's, if we can, kind of dig into one final piece for educating LP investors. And we talk a lot about due diligence. Clearly, you're much more skilled and have much more expertise in this than I do, or probably anybody I've ever had on this podcast. Um, is there one or two due diligence questions that LPs should be asking that maybe they're not? Kind of common themes that you're seeing as you advise LPs?
Yeah, this might be a little bit controversial, but I don't think it should be. I would ask a GP for a reporting package on one of their investments, and ideally, before asking for it, you should try to figure out which one might be struggling. Um, and just to clarify, that's not to be like, aha, I got you. Like I found one of your struggling investments. but rather it is to check how they communicate with LPs when times are hard. And I think that's especially important if you know that an investment is in trouble. Maybe it's in the news or whatever, or you found out. Or perhaps you can just deduce from the basic facts that it's probably not going amazing. And then is the reporting update talking about the new dog park with pictures of the Thanksgiving party? Or is the reporting update like, hey guys, like, it's a little tough out there. Like, here's our plan. This is what we're going to do. And I think if it's more of the latter, then it's actually pretty promising.
Yeah, I love it. And I'm so glad to hear you say that. I just started asking that probably 6 or 9 months or so ago, where I actually will ask for the reporting package for all of their current deals. And you'd be shocked to see some of the responses I get from GPs. They're not always excited to share those with me. And if I get those responses, that's usually pretty telling on what's going on with their current portfolio. So, I like the fact that you mentioned too, like, ask some of the hard questions on the front end and then ask for those reports. And let's also make sure that their answers align with what's going on in their current portfolio as well. So if I find the gotcha moment with somebody, that's usually pretty telling, I think, too. So, well, cool. Well, those are great answers. A couple of fun questions here, if we can, just to wrap this up. Do you have a recent a recent bucket list item you've checked off your list, or one you hope to in the near future?
I had 3 kids under 3.
Oh my goodness.
Okay. I'm not sure it was on my bucket list, but it happened.
Okay. I was waiting for the sleeping through the night is a bucket list item I'm trying to get through. Right?
Yeah. So, I mean, that was a few years ago, but yeah, I enjoy my kids. I think running a business is on the bucket list. It's never always up, but like, I'm very thankful for the little niche that I've developed, and like, I don't know, I just keep trying to build and doing the right thing.
I love it. Well, you're bringing a ton of value to your audiences for sure, myself included. So we thank you for going through that entrepreneur roller coaster, which I know oh so well.
Yeah.
All right. Final question then, kind of our money question. If you had $100,000 you had to place today into a deal and you couldn't put it into something that you're affiliated with in any way, where would you put that $100,000?
You're going to laugh at this, but I'm going to say education, but not the type of education that you would think. Okay. So what I would do is put the $100,000 into Robinhood and leave it at 4%. And try to get a bunch of deals and look at them. Like for 6 months.
Yeah. Just
see, I don't know, a deal a week at minimum for 6 months before you do anything. And then you can sort of start developing habits, understanding, don't pull the trigger too early.
Yeah, I love it. I absolutely love it. That is really, really good advice. And the very first time I've ever heard that, like if you had $100,000, you would say, let's go ultra conservative and focus on our education to make sure when you do place that capital that you're making it from an educated standpoint. So very good. Yeah, no, this has been a great conversation. I feel like we could have spent another half hour plus. I've got a dozen other questions here that I didn't get to ask you, but I really do appreciate you coming on the show, Aleksey. I appreciate the service that you're offering as well through your GP or LPGP match and your blogs as well. I've learned a ton from you, and I really appreciate your time coming on the show today.
Thank you so much. It was wonderful speaking to you. Thanks for taking the time.
Awesome. All right. And to our audience, as always, we encourage you to continue that education journey. And just as important, if not more important, I would say make the decision that you will be investing in your first or in your next passive investment. I am convinced that once you get into the space, from an educated standpoint, you will be so happy that you did and just wish that you started that much sooner. So be sure to join us again next Thursday for another great episode. And thank you again for joining us today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.